interest rates, have stabilized, and that provides a lot of visibility for REIT investors and REIT players, both public and private. And then the supply demand backdrop is pretty favorable right now too. We can name a number of sectors that are benefiting from decreasing supply and demand that's stable. And so we think this is a really great window of accelerating growth for the space and very resilient dividend yields as well.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgson-Keto. My guest today is Gina Szymanski, Global Chief Investment Officer at AEW's Global Securities business. Gina is responsible for managing AEW's full suite of REIT strategies in the US, North America, Europe, and Asia Pacific. And she's with me to share her thoughts on what we could expect from REITs in 2026. Gina, welcome to the podcast.
Thank you, Sarah. Thank you for having me.
So, Gina, as we talk today in early 2026, how do you think REITs and commercial real estate are positioned to navigate the key macro factors that you anticipate for the year ahead?
Sure. Great question. I think to answer that question first, you really have to think about the key macro drivers that we're looking at in 2026. They're not that different than the ones we usually look at, but just thinking of what we are paying attention to. Number one, job growth. Number two, inflation. Consumer spending, GDP, and of course, Fed policy, but more so the 10-year and how the 10-year responds to Fed policy. Now, we think REITs are positioned well for this backdrop. I mean, the backdrop I would characterize as relatively strong. I know a lot of folks in the investment community are worried about a recession, but if you just look at, what job growth is, what inflation is, consumer spending, GDP, all are metrics that are fairly strong right now. A lot of concerns circling whether or not these favorable backdrop will persist, but generally speaking, we're in a favorable macro backdrop. And we think that's, a positive for REITs. You don't want weak demand for REITs necessarily, because a lot of demand that comes for the underlying space that landlords own does come, kind of start with a stronger economy. So demand is good, given the economy is doing well. We think supply, and that's the what's in the pipeline in terms of new deliveries. That's good and getting better. And then with inflation, essentially being right around where the Feds globally are thinking about their targets, maybe a little bit high, but not too far off. We think interest rates aren't really poised to go much higher, and with a little bit of luck, maybe they'll go a little bit lower. So demand good, supply good, interest rates stable is a pretty good backdrop for REITs and real estate.
Great. And now your remit covers extensive regions around the world. Can you talk about what you're seeing in global real estate trends and how you expect different geographic regions to perform against one another?
Yeah, so I would start by saying globally, REITs overseas, non-US REITs, significantly outperformed the US in 2025. And a big driver of that was FX, right? So if you think about the US, you have lower interest rates, which is, drives a weaker US dollar, and that means better non-US returns. It was the exact opposite in 2024, where US outperformed global. I think with inflation being more manageable around the globe, not sure that FX benefit will repeat again. So what I would say is, more importantly, we're looking really at the monetary and fiscal policy trends, in the different regions. And, the bond market, and everyone always talks about how good the bond market is at assessing risk. If I could only look at, one metric across the globe for every region, it would be, the respective borrowing rates in each region, and kind of gets you, a lot of information. And I think all else equal, we do see more constructive on regions where the 10-year is lower, and inflation's more manageable. Just because REITs, are capital intensive business, and when borrowing rates are high, it is a headwind, and when they're not high, it's a better opportunity in terms of being able to utilize that cost of capital to grow.
And as you position the AEW Global Real Estate Fund for 2026, are there any sectors that you're particularly positive on? And are you anticipating any sector allocation changes?
So in terms of how we're positioned for 2026, I don't think it's that much different in terms of how we ended the year in 2025. Maybe on the margin, a couple of sectors we feel a little bit better or worse about, and we can get into that. But for the most part, the sectors that we've been overweight are still our favorites. So number one, seniors housing. We've been overweight that across the globe, given the positive demographics and the aging demographics around the globe. That's putting a nice tailwind for that sector, along with just a cyclical recovery stemming from the issues that industry had with during the COVID time period. Number two, data centers. We continue to like data centers across the globe. We get a lot of questions about AI and whether or not we're worried about AI. And of course, we're always worried about everything. But in terms of the supply demand fundamentals, we definitely see growth still within the data center space. The rents across the globe are growing, and that's stemming from low vacancy rates. And yes, supply is coming online in response to the demand, but absorption currently is historically high, and it takes a while to deliver the assets, and those assets are being delivered at really strong returns. So we like that sector as well. And then I would say third is retail, and I'm really citing sectors that across the globe are stronger than other sectors. And again, so that's retail. Retail, we see fundamentals across most regions very strong. Consumer spending is strong. I mean, here in the US, we're looking at consumer spending, and just in December was close to 5%. We're seeing similar trends overseas. I know there's a lot of discussion around the K-shaped economy where, the higher end consumer is doing better and is more resilient than the lower end consumer. But to a large degree, the REITs do own properties that are located in geographies with higher household incomes and not necessarily as exposed to the lower end consumer. So we see strong fundamentals there as well. Those three sectors we don't really anticipate changing our allocation to. I would say where we are feeling better on the margin is industrial. Our fund had been slightly underweight and even more underweight a couple years back when the Fed started, increasing interest rates, and you saw a big slowdown in the demand take up for industrial space. We had moved underweight, and we've been slowly kind of creeping that back up. And the recovery of industrial has been persistently getting pushed out, but we do see evidence that finally that recovery should be underway in short order. And so on the margin, we're feeling better about industrial as well. I think lastly, I would mention, a sector that we'd love to get more constructive on, but is still trying to find a bottom is self-storage. Self-storage is a great business. Cash flows nicely because of the low capex nature of that business. And that sector has been hit by higher supply and lower demand. The housing in the US has not been very strong for the last couple of years, ever since mortgage rates became elevated and affordability has become an issue. But we would love to get more positive on that as fundamentals start to recover. We just don't see that recovery as quite imminent just yet.
And REITs managed to perform well in 2025, even with trade tensions and higher interest rates in play, while also maintaining balance sheet strength and disciplined access to capital markets. How has REIT performance stacked up to other investment options, and do you see those trends continuing?
We get a lot of questions about why REITs have underperformed the broader equity markets. And it's not that hard to understand that, the main reason why REITs have lagged the broader equity market is because rates really have been high and not come down as fast as the market would have liked, especially in 2025. We'll see what happens this year. But for the most part, around the globe, the Federal Reserves around the globe have been dealing with persistently higher inflation, kind of higher for longer. And that's always a disappointment when it comes to real estate investing, where, again, they're capital intensive businesses and really need borrowing rate to come down to make it accretive continue to grow. I would say from a technical standpoint, I mean, you asked if this would persist. From a technical standpoint, the REITs aren't really pricing in much benefit from lower rates at this point. Whereas I would say a year ago, there did exist a lot more hope that rates would come down quicker. So in terms of whether or not, this is a good entry point, I would say that it's a better entry point now than it was a year ago. I think another factor, driving REIT performance is just the relative growth. There is, in the broader economy, a really strong appetite for growth, right? You can see it in general equities. Everyone talks about NVIDIA, AI, and all that impact and what growth is going to be driven by that. You look at the S&P 500 for 2026, 2027, the growth estimates out there, consensus estimates are for 15% growth. The S&P is trading, 23 times. And so, that relationship between, what you're paying for the growth is not so bad, right? So for the broader equity market. REITs, we're experiencing some of the best growth that we've ever experienced. Okay. Our forecasts this year are for almost 6% growth and potentially accelerating to close to 10% in 2027. And we're trading 16 to 18 times. Not as exciting. If I'm thinking I'm a generalist equity investor, why would I pay 16 to 18 times for 7% growth when I can pay just a little more for 15% growth? And so I think that phenomenon is really impacting some of the generalist investors. But what I would encourage investors to think about is how likely that 15% growth is, right? The 7% growth in REITs is very visible. These REITs have long-term contracts, and you can see the rents rolling off versus the market rents. Again, the backdrop for the economy is relatively stable, so that 7% is pretty visible. Whereas I'm not a generalist equity specialist, but I do hear a lot of the concerns that people voice regarding what's likely, and will AI drive a lot of the productivity improvements that people do hope and expect for the broader market. It really just depends on what happens in the broader market and whether or not 7% growth looks attractive to the broader equity investor.
You would say that REITs offer really quite a stable prospect for investors right now.
Oh, absolutely. When I think of the average investor, especially the aging demographic, as you get older and you're looking for yield, and these companies pay out 75 to 80% of their cash flow. We're looking at mid-single digit dividend yields, historically cheap cash flow yields, and the best growth that we've seen in probably a decade. And so the setup for us is great. And I would highly recommend the average investor take a look at REITs here. But, to your question about whether or not they'll outperform the broader equity market, in 2026, it really kind of depends on what happens with the broader equity market and people's expectations for growth in that outside of the real estate landscape. But real estate right now is definitely positioned for a nice double-digit return.
And Gina, we did see a fair amount of REIT M&A activity in 2025. Do you think we'll see more of that in 2026? And what impact could that have, and where might we see it?
The M&A is really stemming from a very large discrepancy between public and private real estate valuations. So this gap has persisted going on nearly 4 years now, pretty much ever since the Fed started raising interest rates in early 2022. Now that interest rates have stabilized and no lot longer seeing demand for outflows from the private real estate funds, those private investors are now looking to deploy capital again. And so we're seeing a lot more interest in public REITs from private players. Even those who have historically not played in the public REIT space are starting to brainstorm ways to get involved. In terms of which sectors we expect the most M&A to occur, I would say shopping centers, apartments, industrial, storage. I mean, the list goes on and on, really. It's not that private real estate is expensive, but when I speak to private players, their opinion is, why pay market when the assets located inside of the REITs are trading at 30% discounts? So it's much better and lucrative for them to go after the assets inside the REITs rather than paying market.
And Are there any particular secular or cyclical trends that you will be watching this year, which really could inform or influence your investment strategy?
Absolutely. So we think a lot about what our opinion is of the macro backdrop. And right now, our base case is not a recession. So we started this conversation talking about really how strong the economy is, right? With GDP close, 4%, job growth slower, but 50,000 jobs, I mean, over the course of my 25-year career, it's not too shabby. Yes, it's paled in comparison to the strong labor rebound coming out of COVID, but we can live with the 50,000 jobs a month and consumer spending at 5%. I mean, it's really all quite strong. And I know there's evidence of certain parts of the economy that are weaker, but that's always the case. So our base case is not a recession. What would make us change our opinion and our positioning is if we saw more evidence that a recession was imminent. Right. So there are sectors that definitely work better in a recession scenario, especially if interest rates fall quickly in response. So, towers, for example, or net lease, these are more bond-like REIT sectors with longer duration and less correlation to GDP growth. And so we would probably lean more towards sectors like that if we thought a recession was coming. And then similarly, we talked a little bit about, data centers and AI, but right now the fundamentals are pretty tight. But if we saw evidence that demand was shifting from that respect, then it would definitely cause us to take our earnings estimates down. I mean, to have to rethink our overweight there. But otherwise, we like how we're positioned and we're optimistic on multiple sectors here and the overall backdrop for real estate going forward.
We've covered lots of ground, but anything else that you'd like to touch upon before we go?
No, I think you asked a lot of good questions. In summarizing, when you think of what makes or breaks real estate, it's really supply, demand dynamics, and interest rates. And we think we're at a good point for both, right? We talked a lot about how interest rates have stabilized, and that provides a lot of visibility for REIT investors and REIT players, both public and private. And then the supply demand backdrop is pretty favorable right now, too. We can name number of sectors that are benefiting from decreasing supply and demand that's stable. And so we think this is a really great window of accelerating growth for the space and very resilient dividend yields as well.
Gina, thank you so much for your time today.
Thank you. Thank you for having me.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.